In the stock market, we call this a complete and utter disaster. Celsius stock is now down around 69% from where it was back in early summer, late spring. An absolutely dramatic fall. Year to date, the stock is down somewhere between about 45% and 50%. Right now, it's down about 49% so far year to date. It is very ugly. I do always want to remind people the 5-year on the stock is absolutely incredible. Even after this epic, colossal crash of 69%, in a very short amount of time, the stock is still up 2,600% on a 5-year basis. And so I do think that is worth mentioning here. So the stock's a complete disaster. People want to know, is the stock a buy here? Is it not a buy? Those sorts of things. So I want to dive into this one. I just want to focus on Celsius in this video here today. Really speak about this one, really talk about this one in depth, because I do think it is about that time we really go in depth in regards to Celsius here. And this is a stock that I am now starting to increase my buys on. I just started a position here very recently. And if we look here at the public account, so far in regards to Celsius, I have about 500 shares. I'm looking to increase that stake pretty dramatically over the next 3 months, as long as this one does stay in a lower place, which you got to keep in mind in regards to Celsius' stock price. This could go lower. This could go down to 25 bucks, 22 bucks. I wouldn't necessarily bank on that, but there's a decent probability this one's going to go down to 25 or even 22. And once again, don't bank on that, but here's why this could easily go down to those sorts of prices. Listen, everybody that bought Celsius stock in the last at least year or two has lost money on the stock, and some people have lost dramatic amounts of money. A lot of funds have lost dramatic amounts of money. You don't push a stock up this high without even big money coming behind you, right? We're now in the fourth quarter of the year. What happens in the fourth quarter year? People do what's called tax loss harvesting. So there's going to be a lot of tax loss harvesting in this stock, likely in the fourth quarter of this year. Basically, it's people that have made money in other stocks. Let's say you own Meta stock, took a bunch of profits, great. If you own Celsius stock simultaneously, you're probably down huge, unless, once again, you bought it 4 or 5, 3 years ago. That's a whole different situation. But if you bought it at any point really in the past year or two, you're probably down a lot. So you could go ahead, sell your shares, then go ahead, buy them back at some point in the first quarter, second quarter, and you got to write off your loss against your gains, right? So that's what happens with a lot of these stocks that have a devastating time in the stock market, and certainly Celsius is fit in that category. So let's go ahead and dive into this. By the way, I appreciate everybody joining me as always. Thank you everybody that smashed that thumbs up button. Thank you everybody that subscribed to the channel. Appreciate each and every one of you guys for being here as always, okay? So let's take a peek at Celsius. First off, I want to start here looking at the trailing 12-month revenue for Celsius, right? Looking here at the charts on 1000xstocks.com. I mean, it's doesn't take a rocket scientist. You don't have to have an MBA in business to understand. That's a very impressive chart, right? The revenue has just been up and up and up. Celsius' brand has been growing immensely over time. They've been attracting more customers, and their business model is pretty dang sticky. When somebody's used to drinking Celsius, they continue to drink Celsius, right? It's one of the reasons that Monster was such a great stock for me back in the day, right? And by the way, I've started a Monster position now too. I started a Monster position. So far, I'm at 222 shares, a little bit smaller than Celsius. And my plan is for every dollar I put into Celsius, I want to at least put 50 cents into Monster. That's my goal in regards to this as a hedge overall. Rather than just going all in Celsius, I want to go Monster as well. I do think Celsius has a lot more upside potential over the next 3 to 5 years than Monster. But Monster is a far safer company, in my opinion, due to their diversification and just being much more well-established in the marketplace. By the way, look at Meta. Meta's flirting. It's flirting with becoming $1 million position here in the public account, which is incredible. Now, additionally, when we look here, we look at the margins of Celsius. It's clear the trend has been up and to the right, which is also something you definitely want to see in a company, right? So the revenue's on the right trajectory. The margins are on the right trajectory, even in regards to net margins. And keep in mind, this company is very early days in their profit cycle. I mean, if I think out 3, 5, 7, 10 years from now, Celsius's earnings per share and net income should make the current net income and earnings per share look like a joke, okay? So looking at the EPS on a trailing 12-month basis, it's clear where we've gone with this one. And, if they pull this off over the next year or two, I mean, the earnings per share should increase dramatically from here. And like I said, it should make today's numbers kind of look like smallish numbers in regards to this one. But what's everybody all up in arms in regards to Celsius? Well, here's the deal. I'm looking here at analyst estimates on SA for this, right? And Seeking Alpha has basically 14 analysts that have numbers out for Celsius here, right? And they have Celsius's revenue being down 25% in the quarter they're about to report, which is an unmitigated disaster for Celsius. Celsius, you're expecting this company to grow. You have your revenue down 25%. That doesn't exactly, let's call it, make people very confident. Then additionally, for next quarter, revenue is supposed to only be up 5%, right? Very disappointing, extremely disappointing. If they come through with those numbers, that's disaster. Now, I want to go ahead, and we'll come back to this in just a moment, but I want to look at earnings summary here for Celsius. So if we take a peek here, they beat last quarter's numbers on earnings per share and revenue, and they reported 23% growth. So if you go from 23% growth to 25% shrink, oh boy, people are going to think your business model is broken. That might not be the reality, and I actually don't think that's the reality for Celsius. If you want to know why Celsius's revenue is screwed up here, the real reason behind this is Pepsi. They have a Pepsi distribution deal. That deal started going into effect in 2022, and that definitely pushed up numbers in a massive way in 23 and into the beginning of this year. But Pepsi's leaning out inventories in a major way. And so that hurts a company like Celsius big time if they're going to lean inventory. Now, that's not a long-term problem. That actually puts Celsius in I think even a more real strong position long-term. But for the short term, there's no doubt that hurts your numbers significantly, right? And so you take that along with scanner data that's been okay, but not super exciting, and it leads to just a very poor sentiment in regards to Celsius' stock, right? Very, very poor sentiment. Now, I've gone through this with companies. I've seen it even with a stock that I own that's in the gulag right now, Honest stock. Honest is a company that they've gone through time periods where Amazon would cut inventory levels, and that hurt their numbers significantly in the short term. Then they got through that, and it was all up from there, right? But it is something you have to go through, so it is something to kind of take into account here. Now, the other additional problem is the growth rates had been ridiculous for Celsius. 77%. 116%, 157%, 192% growth in revenue, 166%, 136%, 98%, 70%, 94%, 111% revenue growth, 104% revenue growth, 95% revenue growth, and then down to 36, then down to 23, and now they're talking about negative 25. So you can really understand why the stock fell off a cliff. Because at the end of the day, you can't go from being a 90% grower, 100% grower your revenue down 25%. That's just, there's no other way to put it. Your stock will crash. And that's exactly what's happened to Celsius. So I can't say the stock didn't deserve it. I can't say that at all. I think it did deserve this. And if it goes, like I said, if it goes down $22, $25, I wouldn't be surprised. It deserves it. If you go from those sorts of growth rates down, and regardless of what the reason is, regardless of the whole Pepsi thing, you can't have that happen. That's a disaster, right? So this is what happens when you're a brand that was completely unknown and then you make it to the mainstream, right? You're able to put up some ridiculous growth rates. Now, I do not believe that this is reality, meaning the 100% plus growth rates. I also don't believe the revenue shrink that they're talking about in this upcoming quarter. I don't believe that's realistic either. I think both those are completely unrealistic. I think Celsius is going to grow probably, my guess is somewhere in the 15% range per year from 2025 through many of the future years. Potential of, if things go really bad for them, maybe 10% revenue growth. On the high side, maybe 20% revenue growth, somewhere like that, right? Now, in regards to sentiment for the stock, sentiment's really bad, which the stock crashed. I'm not surprised it's really bad, right? So this person says Celsius is like a headache that won't go away. I mean, yeah, that could be one way of putting it. This individual says, it's quite amazing. I sold Celsius at $92, they claim. The reason was simple. Fundamentally, it's way overpriced. If such case happen, I look into technical. Technically, it's also heavily overbought. Listen, okay, bunch of BS here. Listen, if you sold Celsius because it was overvalued, you could have said the same at 80, at 70, at 60. In fact, at $90, you could have made a case that it was undervalued if they kept growing at those sorts of growth rates. Now, if this individual felt like the growth rates were completely ridiculous, then they should have said that. That should have been their case. They should have said, I thought the revenue growth was going to decelerate massively. I thought they couldn't. That would have been a whole different situation. But saying it's overpriced, you could have made the same case for Celsius on the whole run. The whole 5-year run for Celsius, where it went up 4,000%. You could have made a case every month, every quarter, every year that Celsius was overvalued, right? And it proved you wrong. A good example of that is Costco stock, right? Costco stock, I mean, my gosh, this stock's ridiculous. Have you guys seen Costco stock? This stock trades at the most ridiculous PE ratios. This is Costco. Costco. Like not some fast-growing tech company, right? It trades at a forward P of 50. Trailing 12-month P of 52. A 2-year forward P of 47. It is so ridiculous that it can make even companies like Nvidia and AMD look cheap. Like it's ridiculous, right? I mean, look at this. Costco's forward P is way ahead of AMD, and it's even above Nvidia. The 2-year forward P for Costco is significantly above AMD and above Nvidia. I mean, these are two of the most impressive companies in the history of mankind. In its trade, it makes Meta look like the cheapest stock in the world, right? Meta, a company that's going to way outgrow revenue and earnings per share over Costco any day of the week, right? And that has a worldwide customer base. Look at this. Meta trades at half the forward P than Costco. So the moral of this story is a stock could look rich and overpriced and overvalued for a long, long time, right? Chipotle is another situation. Chipotle is another one of those stocks you could always look at. Chipotle, you could have made a case for the longest time that this stock is overvalued, right? Amazon's another one. You could have made a case every single year. Amazon's an overvalued company, and it's actually always undervalued. Tesla, you could make an argument on that one since the beginning of time that it was way overvalued, and yet it still trades at ridiculously high forward Ps, 2-year forward Ps, all those sorts of things, right? So the moral of the story is, like, when it comes to a stock like Celsius, if you saw the revenue going down, then you got a case. But if you just say, well, it was trading at high PEs, that's not a good enough case, right? Now, so let's run some numbers here. Let's run some projections and try to figure out, is this stock a steal deal or what's going on here? So analysts have, as far as next year goes here, 27% growth in earnings per share. They have 20% growth in revenues. So let's run a 20% and 27% average for the next few years for this one. Okay, so let's say 20% top line growth, and then let's run 27% bottom line growth on average for the next number of years. That puts them at 19% margins here, which is not too crazy, and I'll show you in a moment why that's not too crazy. So an energy drink company is extremely sticky business model. You're going to give that business model a lot of respect, right? No different than a Coca-Cola, a Monster, any of these companies. Can I open this on a new tab? Yeah, let me open this on a new tab here. I want to show you guys. I want to do a compare on Coca-Cola, compare on Monster, and a compare on Celsius is here, so you guys can see kind of the margins of more mature business models. So if we look here at the compare feature here on 1000X, which, by the way, if you want to apply for access to 1000xstocks.com, you can go to 1000xstocks.com and apply for access for that. So if we go ahead and take a peek here on the compare feature, we're going to see the margins, gross margins. Celsius isn't that far behind these guys when it comes to gross margins, right? Net margins, as far as getting to Monster's level, still quite a few percentage points to go up there to Monster. Monster's 22% plus. Celsius is under 20%. Coca-Cola is just under 20% as well. Keep in mind, energy drinks are seen as better margin profile than soda. Soda's just been beaten down over the years in terms of their margins. It became a very price-sensitive business. We do know that, right? Where energy drinks, not nearly as price-sensitive. They're just able to command bigger dollars. Somebody's willing to pay $2 or $3 for an energy drink when a lot of times people are expecting to pay $1 or less for a soda. It's a different kind of frame of thought there, right? So Celsius has a way to grow in regards to margins, but I want to go back to valuation here for Celsius. So 19% margins 2028. Don't think that's crazy. So I would say about a 35 to a 45 range would be appropriate. For a company growing 20% plus a year that's in a sticky business model like this, no pun intended, 35, 45 is cake. And so when you run numbers like that, you're getting a stock price that's income 2028, which as a long-term investor, that's what I'm thinking about. I'm thinking out 3 to 5 years, right? So I'm buying the stock now at the end of 2024, thinking about where the stock will be in 2027, thinking about where the stock will be in 2028. So the stock should be somewhere between $98, which is actually hilarious because that's where the stock actually peaked, several months ago, and about 126, which gives me a compounding annual growth rate on the low end of about 35% and on the high end of about 43%, right? Now let's say those numbers are too ambitious. So let's run a 15% number here on the top line. Okay, let's run 15%. And then let's run 20% on the bottom line growth. Okay, so significantly kind of under what analysts are expecting here. Now we could take PEs down to 30 and 40. All right, so we'll take them down to 30 and 40. So then we can see where roughly this is valued here. See how fast this is? It's just beautiful. I mean, this used to take me so freaking long in my spreadsheets to do all these numbers and try to run all these different projections. Now it's just done in seconds. It's beautiful. So now we take a peek at Celsius, 67 to about 89, right? 23% compound annual growth rate on the low end, 32% on the high end. Very attractive. And honestly, I don't think those numbers are a stretch at all. But let's go even more tame. Let's say they get no leverage. Let's say they get in a super big price battle with Monster over the coming years. And let's say it's just a war. And so they, even though their revenue is growing, they can't really lift their bottom line at all. And let's say because they're expanding into international markets, they just get no lift in the bottom line. Even in that scenario at 15%, right? You're still talking about, at a 30 PE, 17% compounding annual growth rate. Keep in mind, at a 15% growth rate on average per year, in the energy drink category, you should be able to command a bigger PE than that. You should, right? I mean, if we look at Coca-Cola is able to command a 28 trailing 12-month PE. 28. And the trailing 12-month earnings per share growth is 1.5%. Trailing 12-month revenue growth is 5% for Coke. And it's still able to command a 28. So a stock like Celsius should easily, if they're growing 15%, easily be able to command a PE at 30 plus. And that's not even stretching it. That's not even stretching it. I think, probably closer to a 40 would be realistic, which gives you a compound annual growth rate of 26 there, right? So this is why Celsius is such a dang attractive stock. It is such an attractive stock right now. And as long as their stock is under $30, it has to be a buy, man. It has to be a buy. And so what I'm planning on doing with this stock is I'm planning on aggressively adding shares for the next, I would say, 3 to 6 months in regards to this one. The next 3 to 6 months, generally speaking, the winter time is a weak time for the energy drink business and the drink business in general. Like when it's hot out, people just drink more stuff. So I'm looking at Celsius, and I think this stock, my hope is the stock remains in a lower place for at least the next 3 months to 6 months, which I don't think is crazy to imagine. You've got tax loss harvesting. We know we're going to have a bunch of tax loss harvesting coming in the stock, right? Maybe the numbers are good. The stock goes up big the next day, but then maybe it gives back some gains over time because you can still get more tax loss harvesting, right? And then winter time's kind of just weak in general. Now, if we could add some weakness to the market in general, then we're talking about a whole different situation. If we could get the market to be weak as well, we could get the stock down that 22 range or somewhere around there, which would be perfect, absolutely perfect. So Celsius, yeah, definitely looking to add this one and as many shares as I can here. I love the setup here. I mean, everything is looking exactly how I'd want it to look for a company. Everything across the board, man. This is what I want to see. That's what I want to see on a trailing 12-month basis. That's what I want to see from margins. That's what I want to see on a trailing 12-month basis with earnings per share. This is what I want to see with stockholder equity. Up and up and up and up. Beautiful. All right, guys, appreciate you joining me as always. Pin a comment down there today if you're looking to apply to join private stock group and get access to 1000xstocks.com. If you want, you can go straight to 1000xstocks.com and apply for access there. Much love and have a great day.